Well, team, it was a worst case scenario. Worst case scenario today. I'm not quite sure what to do. Maybe we'll crack one open here, huh? Maybe one of those kind of days. That's some good stuff right there. Let me tell you. 0 calories in that right there. All right. So, I'm not going to victory lap this, but the video from yesterday, I said we had 117 basis points of downside, and look at that. Can you believe it? This is another one of those giant red candles that just wants to stab me in the head. Give me in the head. Stab me. And that's exactly what it did. So I said yesterday, the title of the video was Lock Your Loans. Lock them. Anyone who got caught floating today got what you deserved. There's no reason for it. You should be able to at least know inflation reports coming out, hot inflation time frame, not a good time to float. But look at that, 117 basis points. So we said yesterday, hey, our downside is 117 basis points. I literally said exactly 117 basis points. And I'm not going to victory lap it, but watch yesterday's video. That's what we said. That was the worst case scenario. That's exactly what happened. I mean, exactly 117 basis points down. The horrible, horrible day. We are now sitting at the COVID lows. So March 2020, almost exactly 2 years ago, 23 months ago, when COVID hit and the markets panicked, we got to this point before we catapulted higher based on stimulus. So we're now back to that point. We're back to where we were bond-wise. But the sentiment is much worse because at that time, there was a little bit of panic. There was a lot of unknown, but it was turned around very quickly with some good news. We not only are missing good news, we have nothing but bad news. I'm going to be a bad news guy for a while. I don't want to be that guy, but that's just where we're at. So 117 basis points. Look, you can't even see the whole thing while I'm on here. Let me get out of the way. Derrick Evans here, NMLS 155010. Give me a call. Shoot me a text if you want to buy or refi. Who'd want to refi now? Actually, people who can still save money. I talk to people who have 4+% every day. It's crazy. So we lost 117 basis points. Mortgage rates got clobbered. I'm going to pull up rates here in just a second. So we're going to do a rate check. We're just going to kind of see where things are. Pretty much, you're looking at today, rates went up 0.25% today. Today. This is too much, too fast, guys. This is what I've been talking about. This is problematic. And the really crazy thing is, I watch this action all day. These are daily candles, by the way. Just a reminder, when bond prices go down like this, that means mortgage rates go up. We want to see bond prices going this way so mortgage rates can go down. Down it was. Today was pretty bad. 117 basis points. We haven't seen that. Gosh, I don't know when the last time we saw 100-something basis points down in a day. But it's bad. So 0.25% in a day, in one day, off a hot inflation reading. Let's go through that. We'll look at just a couple things. Not going to look at a lot today. I'm going to make this relatively quick, but I want you to know some of the key points, some of the key takeaways from today on top of the fact that mortgage rates are getting murdered. And we just have to sit by and watch it. But what I was saying was the action. So at one point today, we were down like 40, 50 basis points. Let's call it halfway here or somewhere in there. And I was like, well, gosh, we're kind of screwed. Even if we rally back up to here, it's going to get killed from there. I watched. It was a big buyer. It had to be the Fed. It had to be the Fed who was in there buying. It had to be. Because it was a lot of move. I mean, this candle went up a lot in a short period of time. Someone dropped a pretty big market order in there. And you would only do that if you didn't care about losing money. You would only do that if you had no P&L and no accountability, which the Fed, of course, has neither. So it had to be them. And they got absolutely run over, steamrolled, which leads me to believe, and I almost titled this video, the bond bullies are here. Almost titled it that, because that very well may be what's going on. Bond bullies might be here now. If they ran the Fed over today like it looks like they did, this is going to get a lot worse. God, I hope I'm wrong. But that's where we're at. Lost 117 basis points. So what was it? Now, cities coming out, forecast Federal Reserve to raise by 50 basis points in March. Okay. Another month away. At this pace, rates will be at 10% by then. So too little, too late from the Fed again. Imagine that. Here's one. Kellogg going to raise prices again in 2020. Notice here, they're not afraid to say this out loud. Double-digit cost inflation. We're being fed this, 7.5% number. We'll get to that in a second. And anyone with any common sense knows that that's wrong. It's definitely in the teens, probably in the low 20s. ECB pulled out a number of 28% last week. So could we be that high? Could we be in 20 to 30% inflation? It could be. Used cars are going up in value, for God's sake. It can't be 7.5%. But that's what they're feeding us. Inflation surges 7.5. So what I said yesterday, expectations 7.2. Even if we just had no way to win, even if it had come in better than expected, let's say it came in at 6.5, that's still a terrible number. Instead, it comes in at 7.5. Even worse than the already terrible expectation. And we haven't seen numbers like this since the early 80s. And there were some pretty ugly times. 82 and 87, there was a crash. You know what I've been saying. I don't need to say it over and over. There's one. Tired of inflation. Jeff Cox cracks me up. He's the one guy who has a license to write whatever makes sense at CNBC. Tired of inflation? The Federal Reserve's actions won't provide any relief for months. It's so true. He's so right. It's going to be so far. They haven't really done anything yet. All they're doing is slowly getting out of the way so that the bulls can charge the crowd. That's what I say, the bond bullies. That's what I mean. They creamed these bonds today. Creamed them. And it's not just the mortgage bonds. It's all across the bond sector. When I was explaining to you yesterday that the bond market will be what crashes, and it's in the process of crashing because the big buyer is getting out of the way, and they have told us that already, the bond bullies will be here. They will. It's not that they're coming. They are here. I appreciate that. Yeah, we are live. If you want to comment, feel free. We're kind of just trying to... Yeah, correct. My friend Donald Appleberry, what's up, brother? One of those days is right. What's up, Amber? I see you. My boy Ryan. Be the bad news, guys. Sellers on the sidelines need to realize the the double-digit appreciation party could be over. It could be. And I think what's going to be really interesting though is to see how many sellers get frozen by the fact that their sell-buy situation just gets so much worse on the buy side. Like sellers were already sort of frozen by the fact that, and we're going to look at some data here in a second. Let's just go ahead and get that on the screen. Sellers are already a little bit frozen because of the fact, wait a minute, did I zoom in or something here? I didn't mean to do that. Sellers are already a little bit frozen because it's hard to find the next property, a little bit difficult to buy. Like, but it's more expensive. So even though I get this equity, I'm still going to be paying more for the next place. Well, that situation just got a lot worse. All that math just got a lot worse. So I think you're going to see even more potential sellers staying on the sidelines, which also exacerbates the inventory issue. And that is where we are. Yeah. Well, let's see. Okay, so we're going to look at a couple things here. Altos Research, we like this. We always want to look at the same report, right? This is key. Whatever you're doing for your research on any market, always look at the same report. Always try to look at the same information. I know that sounds weird, but you don't have the right perspective if you're looking at a bunch of different data sets. You will take conclusions from a certain data set that you received from a different one on a previous day or a research time frame. Always look at the same ones. The best way to kind of get a feel for what's going on. So we look at Altos Research, we look at San Diego, and look at this. This week, the median list price in San Diego is over $1 million. 1.125. How about that? Market Action Index is down to 88 from 89, but look, it's still an extremely strong seller's market. There's a couple of things that we look at here that I think are very relevant. We've been tracking median rent, which is now up to $3,500. We saw that, back in October, which isn't that long ago, by the way. 3-4 months ago, 3.5 months ago, 3,300, now 3,500, rent skyrocketing. But most importantly, we're looking at price per square foot. Now, what's interesting about this particular chart right here is it shows you whenever the short-term average sort of gets out of whack from, it's been popping higher. And this is what happens in markets with strong demand, especially in low inventory environments. anytime this average pops above the solid line here, which is the longer term 90-day average, it retreats back to it. And so that's what we kind of saw here in the end of December and heading into January. We had a lot of pent-up demand that came out and paid up for property here in San Diego. And we've now kind of retreated back down to this mean. In math, we call this regression to the mean. And so when we're back to the mean. So I think the market is more appropriately valued right here at this particular moment. And a lot of people are sort of figuring things out. Now, will we continue to see dozens and dozens of offers, on every single home? Well, we're going to find out. A lot of people, a lot of buyers don't really know what's going on. Not every loan officer, believe it or not, makes videos and sends them to their buyers, explaining to them what's going on in the interest rate market. So a lot of these buyers may not even know yet. They may have been quoted 3%, 6 weeks, 8 weeks ago, been out looking at houses. They're going to get the bad news once they get in contract. Once they find one that they like, and they go, hey, what are my payments going to be on this one? And then they're going to find out. So it's going to take a minute for this information to disseminate. It doesn't just immediately get to everybody. And let's go ahead and I am going to talk a little bit about Bitcoin here in a minute, but not a whole lot. But I do want to pull up rates. Well, why not show this one? This is a quote I just gave. 720 credit, VA, 1.25 purchase price, 5% down. Is a 3-unit. And this came up to basically it's 3.375. So again, VA, this is going to be the market where VA is going to shine. And I'm going to sound like a broken record speaking to listing agents here, telling you that the VA offer is stronger than you think it is. And this is one of the reasons. The rates are not going to go up as fast. The more rates go up, the bigger disparity between the VA rate and the conventional rate. So like conventional rates today went up 0.25% to 3/8% for sure. The VA, and we're going to look at it, but VA here, if we really dial into this, it looks like it went up a quarter. Oh, it's 3.5. Yesterday this was 3.25. What happened? Well, if you really look at it though, this is a $1.something million loan, $1.2 million loan, $785 to get 3 3/8. That ain't too shabby, right? Like, so we went up an eighth, a solid eighth, but whoever's getting this loan, I'm going to talk to them into paying the $785. I'm going to give them a $785 to buy this rate down if they don't understand it themselves. So, we went up an eighth, and that's on high balance, above 647,200. So there's just a quick one for VA. Let's go a little bit more standardized here. VA. Let's go 600,000, not 60,000. Let's go 600,000. So we did high balance. Let's do conforming balance. And this is going to be anything under 647,200. And I'll just take that off. We'll keep it at 720. Why not? Let's go single family here. And let's see what this looks like. Did this hold 3.25 today? It did not. So 3.375. Well, yeah, look at that. 3.25. So this is why you got to dig deeper. 3.25, $110 to get it. So while this was 3 1/8 yesterday, we lost a solid 0.8% on VA rates today. Okay, so this is going to be good comparison sake. So we lost 0.8% on VA after getting bludgeoned for 117 basis points in a single day. That just shows you the resiliency of the VA. It's just such a good loan. It's such a good stinking loan. Now let's venture away from VA for a second here. Let's do FHA. These are a lot of the buyers that are going to, they're going to have trouble more and more because a lot of these buyers are buying at their absolute, or not their absolute max, but towards the top end of what they're qualified for. And so as rates inch up on those folks, it really does actually deter them from being able to write offers on certain properties. So 3 3/8 as well for conforming balance FHA. Let's take a look and see if that price is down better. Not too bad. Yeah, we're going to call that 3 3/8 though for FHA, conforming balance. Now let's see if we pump this up a little bit. So let's take this up. We'll just say 800,000 purchase price. And by the way, I'm using 720 credit on here. So normally we use 780. I had 720 in there. So that also should be kind of factored in. And I'm making a mistake by not doing 780. But we're going to keep it consistent today at 720 across the board. And let's see, 3.5%. Quick math on that. 28,000. Let's call it 30,000. Did I get it right? Yeah. Okay. Single family. Let's look at high balance FHA. We're at 3 3/8. Okay, so it's going to jump up. Flagstar's winning big time here today. I think it costs you $1,000 to get 3 3/8 there. You know, that ain't too shabby. Remember, this is no lender fees, no points. So that's really, you know, and we're talking about, like, I'm the one who's saying it, mortgage rate massacre. It is bad. It's not good. But look at the rates. They're really, I mean, we're still talking low threes here. Conventional. Let's see. By the way, this is all purchases too. The refis you can get for conventional, you can get a little bit lower rate, especially if you have a big equity position. But for the sake of pricing these things out, we just do sort of a standard thing. Okay, so 5% down be 570. All right, so 570. And for this one, I actually am going to put it up to 780. Okay, let's see where we're at here. This is conventional conforming balance. So the loan amount is under 647,200. And you can see the APRs are right next to all these rates too, by the way. For anyone who, any disclosure folks out there, the NMLS, CFPB, keeping eyes on me. That's all there. It's just transparency love, y'all. And this is fun. So this is Loan Officer Life. Welcome to it. All right, here we go. Where are we at? 3.99. That ain't too bad. What up, Penny Mac? Welcome to the game. Orion is actually pretty good for, well, we'll call it a loose underwrite. Orion's good for a loose underwrite. They don't have a lot of overlays and stuff like that. So 3.99. Hey, still in the threes. Still in the threes. Remember, we've watched, just through on this channel, we've watched rates in conventional in like, what, since last week? Go from 3.625, 3.75, 3.875, now 3.9. And let's see what happens if we go a little higher here. Let's go to high balance. Let's see what it is. You know, it's going to be more. It's going to be in the fours. We're going to be in the fours. And by the way, I'm just putting 5% down on these two. You know, we're trying to use the same metrics to check these out each day so that the information is relevant in comparison to the previous day. 4.25. CMG is not a bad option there. Let's see if that plays down on the rate sheet a little bit. Yeah, so $699, you get 4 1/8. But there it is. There it is. Fours. Fours, that's conforming. Conventional, high balance. 780 credit. We're in the fours. And this is broker pricing, like no lender fees, no points, small comp we have on these things, set up on these things to help people get good deals. You're in the fours. There you go. I've got a gentleman who is buying new construction. We did a 90-day lock like 3 weeks ago. Conventional, he's going to be happy to know that he's locked in at a lower rate, even on a longer term lock. You can do longer terms up here. It just adjusts the rates, right? So we always look at 30-day locks, but you do 45, they just get a little bit worse. You do 60, they get a little bit worse again. Do 75, they get a little bit worse again. This is the kind of environment where it makes sense to do this. Now, as far as when can you lock, okay, because we've been talking about right now you have to just lock as soon as you possibly can. That's the game right now. Rates are going up. They're going up. They're going up. They're going up. So lock as soon as you can. So with that being the case, when can you lock? Well, if it's a refinance, you can lock anytime. If you're saying, well, hey, we're not quite ready to do our refi because we're fixing up the house. It's going to be another month or something. Get in. Do a longer term lock. You can always bail. You can go to a different bank later if you need to, if rates improve or whatever. But get something in. Get a hedge in. If you're buying a home and it's new construction, you got a longer time frame, get it locked in. If you are buying a home from someone that you know, or you are in a situation where you're going to be buying a certain house, that's the main thing you need. You need an address. So you can't just lock like, hey, I'm locked in at 4%, but I haven't found a house yet. That is not how it works. You have to have an address. If the address changes, the lock is invalid. So as long as you have the property identified, which works for refis, of course, and works for purchases where you're buying a new construction or you're buying from someone you know, then you can go ahead and get locked in. And I would highly recommend that. Highly recommend that right here because when I said worst case scenario yesterday, 117 basis points, I would have probably told you it's a 1 in a million that we'd actually lose 117 basis points. And we have fallen right on this. Now, that's macro support that we're on now. So we have macro support here. Tomorrow is Friday. Fridays have not been good to us lately for good reason. Over the weekend, there's opportunity for more bad information to come out regarding inflation, regarding a number of the things that aren't going right financially in the world right now, regarding potential military conflicts out there, which also impact financial markets. A lot of that stuff can happen over the weekend. So there's been a lot of Freaky Fridays where people are going freaked out and they're pushing the sell button to go home on the weekends and sleep at night. So tomorrow, if we can hold here, I will feel a lot better about it. But tomorrow could be an absolute bloodbath as well. If this doesn't hold, timber. Let's see. 2 year. Will 2 years take us all the way back? Yeah, kinda. Not quite. Here, let me pull it back a little further. You can see here's the COVID low right there. And that's where we are right now. So where do we go from there? Below that, it's not even on the chart. I can't even see it. All I know is that if that level doesn't hold, which it won't, it's just a matter of when does it break and how bad is it going to break. That's the only question. When will it break? Will it break tomorrow? Will it be Wednesday next week or Monday the week after? We don't know when, but that level is going to break. And when it does, it's probably going to be a pretty violent move lower. If the bond bullies are here, like I suspect they are, what I saw today was, in real time, was kind of scary. When you see, I could see what I thought was, and I still believe is the Fed in there buying. This was getting killed, and then all of a sudden you could just see big market orders just pushing up, pushing it up, pushing it up, pushing it up, and then still got ran over. Just ran over. That's pretty scary. If you think hey, the people who are on our side, the good guys, let's call them, if you want to call them that, the Fed, they're in there, they're buying, they're dropping billions in on this to try to hold this thing up, and they can't. They're literally throwing good money after bad. That's what's got me concerned. The rates are going up too much too fast. We need this to stop, but it's not going to. So prepare accordingly. Prepare accordingly on this. Let's see. There was one other thing I want to look at here. Two things that matter: price per square foot and inventory. These are the two things that matter. These are the two things to track. And by the way, with Altos, this research site, I'm looking at San Diego market. I know people watch this from all over the place. Put it in whatever market you want. In fact, you can get super micro even if you're here in San Diego. You can go in here and look at Oceanside. You can look at Encinitas. You can look at a zip code specifically. So you can get really specific. I'm always looking at San Diego, so we're always referencing the same information. But you can see inventory here. It's steady decline lower. And it looked like it ticked up a little bit. Just a little bit here at the very, beginning of the year. But has now met that longer term trend, and we're right on top of each other. So will inventory tick up? It may, but we haven't seen anything like that. We haven't seen anything really significant on that front yet. But remember, it's going to take weeks for this to really show up in the data, to really show up in the field, if you will. I have talked to other loan officers today. A bunch of them have been reaching out to me lately because everybody's freaking out, and they should be. Mortgage business not going to be very, very good. Going to be very, very bad this year. So, what do you do? What do you do? Just do your best. That's all you can do. But a lot of them reaching out to me saying, hey, I got people who are telling me, yeah, I'm not interested anymore. I've got buyers who are asking for payment quotes, and they're going, yeah, this is too much now. And so according to, just internal polling, the people I know, the people who are reaching out to me, they're saying that buyers are exiting stage left. I personally haven't seen a lot of that, but people are saying that's happening, and it would make sense. So the question is just how much. So good luck to us. What's up, everybody on the stream? Feel free to drop a comment, say what's up if you want to. I'm going to cover a couple things on Bitcoin real quick, and then we'll circle back on a couple other things. So this is what we were tracking today. So the green lines here, this is the macro trend higher. This is the channel. Those are parallel lines that happen to line up perfectly with the bottoms and tops in the market so far. And you can see that a little bit better when you zoom out. There it is. So what we were facing today for Bitcoin was this previous support level that's becoming resistance. I feel pretty good about the idea of what's going to happen next. Where's my drawing tool here? Oh, I really can't find it. That's bizarre. Does that work? Nope. Okay, whatever. So I think we're going to get a reverse head and shoulders is what I think is going to happen here. We've got the shoulder right here on the left side. We got the head right here, right? And then I think this is going to come back down and probably dip down somewhere around 40, maybe 41, 42. Going to make a higher low over here than we had on this shoulder. And that's the most bullish pattern for Bitcoin. The most bullish pattern for Bitcoin is reverse head and shoulders with the right shoulder on our right side being a higher low than the left shoulder. So if that comes down to, here or something and then moves up, we'll have what we need, I think, momentum-wise to get through this particular resistance band here. Tons of crazy stuff going on. So game theory is now in play for Bitcoin. If you guys don't know what game theory is, look it up. I'm not going to explain it, but basically, strategy. We all know Russians are good at strategy. A lot of the top 100 chess players in the world have been Russian for a long, long time. Great strategists. Well, they came out and they said, hey, we're going to ban cryptocurrency. They'd said that, and then almost immediately after, they passed legislation to make it legal tender, to tax it. They're going to make billions of dollars a year on it. I've been telling you what's going on with El Salvador, and also Russia's going to be mining Bitcoin, for goodness sakes. They are playing the strategy game. It's chess. It's 4D chess for them. And when you look at other countries that are competing with them, like the United States, Canada, etc., some of the bigger, the UK, you're going to see that they're going to have to join into the party, or they potentially lose a lot of revenue opportunity and leverage in the marketplace. If it's the case that, and by the way, Bitcoiners all over the world are like a religion. I mean, it is really wild how many people are into it and how into it they are. There's a lot of money that comes from it. El Salvador, which is a small country, has just like tripled the size of their airport. They've done nothing but say Bitcoin is legal tender here. There's nothing that's too much has changed in El Salvador. They have a great president down there. Let's say Bitcoin's cool here, and boom, triple the size of the airport. I mean, so we're talking about there's a lot of money, there is a lot of revenue, there's a lot of tax opportunity for these nation states. They just need to get on board. And you're going to see that start to happen. And never thought I'd say this, and we have Putin to thank. Let's see here. What else am I going to show you on that front? I think that's it. Okay, so circling back, we got a terrible inflation number today. It was supposed to be bad. It was even worse than we thought. I've been telling you what's going to happen with the stock market. It's happening. You're seeing the volatility stuff. There's going to be a lot of volatility. And I hate to say, hey, the stock market's going to crash, but the stock market's going to crash. So when it does, and I've seen several crashes now in my life, what happens is you get just bigger numbers. So volatility increases. You see, we're up 500, we're down 500, we're up 800, we're down 1100. You just start to see bigger numbers come into play. And that's what we've been starting to see here the last few months. It's just like bigger numbers, big up days, big down days. That's usually the precursor for a big move. And I don't think that big move is going to be higher with the S&P at a 45 PE right now. Okay, that price to earnings for the S&P, like a good value is like 10 or 12. It's 45. So that's no bueno. Today, the U.S. 10-year, we talked about bonds a little bit yesterday. 10-year, over 2% now. Over 2%. So that's a mark we haven't seen in a few years. I think 2019 was the last time we saw 2%. It was right. It was when Barry Habib came on my radio show and said that there was going to be a recession and that rates were going to go down. There was going to be 2 refi booms. I mean, he pretty much nailed it. One of the smartest guys out there. And 2%, we're back. How wild. Just completely bananas. Oil took a little bit of a ding today. Gold still hanging around low 1800 areas. And crypto's down today, pretty decent amount. This is a pretty good down day for crypto as well. And we're going to see that kind of like system-wide capitulations prior to crashes. People know what's going on. I don't know if you guys saw this, but Kathy Wood sold all of her Twitter shares the day that they were going to report. You're telling me that someone didn't leak to her that report was going to be terrible, and then Twitter posted a terrible number? She sold, like, not all of her shares. I shouldn't say that. She sold a huge chunk. I think it was 50% or something of her shares before the report. I mean, come on. How can you be so obvious? But this is one of the things that starts to happen is the news starts to leak out to people that it's going to be worse. It's going to be worse. You need to get out now, not where you can buy back in better later. And so it just starts to kind of affect everything. And money starts to get just raised from in all directions. Everyone wants to lighten their positions and everything. Right now, I think most investors are pretty fully invested. And there's very few who are in big positions of cash. And so people are raising cash because they think that there's going to be buying opportunities that will be better in the next 6 months. And so they're raising cash to do that. And that's when you see these system-wide capitulations. And what that means basically is just everything goes down. Now you say, well, these are all green. Yeah, but those rates are going up. So the actual assets going down. That's the same thing with bonds, right? The price is going down. Like we talked about here, price is going down, rate is going up. So that's kind of how it works when it comes to bonds. That's why it looks like, the bonds are green. No. And oil, holding relatively steady here around $90 is really, really interesting. It's really, really interesting to me, but we're going to just continue to watch that. So let's be smart here. Let's know what's coming. Let's advise people accordingly. Just for people out there, I feel so bad. There's like half dozen people who like had a good chance to refi. I told them to lock before today and they didn't do it. Trust me about what's happening next, okay? Just trust me. Whether you use me to do the loan or not, that doesn't matter. I mean, it matters to me, but it doesn't matter to you. What does matter to you is listen to me when I tell you about strategy on how to handle your rate lock, because it will save you money. And if you do want to use me for a loan, give me a call, shoot me a text, want to buy, want to refi, give me an email. We'll see what we can do. I'll be glad to help. All right, guys, have a great night. I'll talk to you soon.